Let's go ahead and get started today. Today we have a lot of logistics I want to cover before we talk about homework 11. So recording is on. Today is Monday, April 26, 2 p.m. section. So I'm going to start out and share my screen here. Just going to give us an overview of, as we near the end of the semester, some things that are coming up that everybody should be aware of in terms of final assignments. So today, you should have turned in your homework 11, which we're going to go over again the solution for in just a few minutes. And next Monday, you need to turn in homework 12, which will be another multiples assignment that'll be due Monday, 10 a.m. for all sections. And I'll be posting that shortly. But that'll be the final individual homework of the semester. Now, the other thing that's going to happen is that a week from Wednesday on May 5th will be your final group project presentation on multiples, 10 minutes on general dynamics. So for your individual assignments, you've been doing 2 companies. For general dynamics, you'll actually do 6 companies. So basically, when you do GD, I'll go to Bloomberg to show this to you. It's probably easier if I share my desktop. So when you go to GD US Equity to work on your group project, you'll notice under RV, as you did in your EIC, under comps best fit, that general dynamics has 3 segments. So it's got a defense segment, it's got a IT segment, and it's got a aircraft and parts manufacturing segment. So what you're going to do is you're going to pick 2 companies out of each of those segments, 6 total, and you'll do GD against those 2 companies in the aircraft and parts, GD against 2 companies for the IT, GD against defense for those segments. Because what you'll notice is that the multiples are actually kind of different by segments. And so you'll talk about it's 3 different segments, same company, GD, but different peer groups. So that's what you're going to be doing during your 10-minute PowerPoint presentation, which again is due a week from Wednesday, May 5th. Okay, so individual assignment on Monday, a week from today, group project assignment, the final one, 10-minute presentation. You kind of know the drill on that, will be Wednesday, May 5th. Right? So also coming up, relative to that, is that on May 5th, that will also be the final day of the Bloomberg Trading Challenge in the second half of the semester. So again, you don't have to liquidate your portfolios. Matter of fact, liquidating early could get you disqualified for the competition because you can't have more than $300,000 of cash at any time. So again, if I go to idea or T message, this is the 2 o'clock, section 301. So this is the competition in terms of if it were end today. It's again fairly close amongst the teams. Any team still has a shot at winning the competition. So again, it's going to be what this ranking is as of end of day on Wednesday, May 5th. And so again, I'll just take a screenshot and do the ranking. Team in first place would get 5. So today this would be 5, 4, 4, 3, 2, 1 in terms of points. I will just say that this is also a really good week for the competition in that there's a lot of earnings calls this week, including Apple amongst other big companies. And usually the trading around the earnings calls as new information comes out is a good opportunity in the trading competition. So you might want to see some of the upcoming earnings calls and take advantage of that in terms of figuring out if you want to exploit anything, if you think the market has any of that wrong. So want to let everybody know that that is due on May 5th. Bloomberg trading competition will end. The other thing that's going to be important is, and you'll see here it says peer reviews. It's not made available yet, but they're going to be made available soon, is 50% of your semester grade are these group projects. And by definition, everybody gets the same grade on your team for the group project, because the assumption is everybody's put in an equal amount of work. So therefore, team project, team grade. If that is not the case, then somebody shouldn't get a team grade if they didn't put in an effort equal to the other members of the team. So that is where the optional peer reviews come in. So the optional peer reviews, which are going to be available this week, and the keyword is optional, only apply if you feel that one or more of your team members did not fairly participate in the group projects. If that is the case, you can fill out a peer review and put in their percentage of effort in the group project from a 0 to 100 point scale. So again, by default, everybody is assumed 100% effort, everybody gets the group grade. But let's just say that for the Bloomberg Trading Challenge, one of your team members, they never showed up for any of the meetings. They ignored all the team emails and texts. They never gave any trading recommendations, and for all intents and purposes, didn't really participate in the trading challenge. Then you should fill out a peer review for that person and give them a 0. Okay. So if one of your team members gives you a 0 on any of these group projects, because you'll basically list the project and list the percentage of effort that you think your team member did in, I won't change your grade. But if 2 or more of your team members give you a lower grade, then I will change your grade. So let's say 3 of your team members said, Joe didn't show up, didn't do anything, 0 effort on the Bloomberg Trading Challenge. All 3 of them gave me 0 for the semester. I'll take Joe's Bloomberg Trading Challenge grade and give them 0 and disqualify you for that team grade. And that applies to any of the 5 group projects. So you can fill out an optional peer review if none of your team members helped you on EIC, historical, valuation, multiples, or the Bloomberg Trading Challenge. I hope that doesn't apply to anybody. Hopefully everybody did their equal fair share of the work this semester, but if they didn't, the peer reviews are the way to say that. Okay, so that will be available this week. The other thing that's going to be available this week is on Wednesday for these individual assignments, there will be an extra credit assignment. It will be worth 3 points to your semester grade. So this coming Wednesday, April 28th, we will not have a lecture. So in lieu of the lecture, I'm going to post an extra credit assignment, which you can work on during class, right? And this will be the only other additional extra credit available to you this semester. So if you're looking for extra credit opportunities, this is the one, okay? Now, I want to remind everybody of how grading works in the syllabus that I mentioned at the beginning of the semester, because it's a little bit unique. In this class, the grade on any one individual assignment does not matter, because what you're doing is you're accumulating points across all assignments to get to a letter grade in the semester. So let's say that you want to make an A in this class. An A means 93 total points across all of the assignments. Now, right now, there's actually 102 eligible points in the class, because one of your assignments, homework 9, was actually extra credit. It was originally 2 points and I made it 4 points. So when I made it 4 points, it actually added 2 points to the universe of points. And so there's now 102 points in the class, but only 100 of them count towards your grade. So to get a 93 in this class, you now have 102 points to make a 93, rather than 93 out of 102. Okay? So ELMS will confuse you because ELMS is not set up that way to do the grades. And if you look at your grade in ELMS, it'll do percentage of total. And we don't do percentage of total. We literally just add up all your points and that equals your grade. So 93 out of 102 will be less than an A because it will be a percentage of 93 divided by 102. And ELMS will mislead you. So don't look at ELMS if you're trying to actually look at the percentage in ELMS, look at the points in ELMS. As of Wednesday, I'm going to add 3 more points. So there'll be an extra credit assignment called extra credit worth 3 points. And so after Wednesday, there'll be 105 eligible points. And again, 93 of them are needed to make an A in this class. 90 of them to make an A minus, 87 B plus, etc. So in a way, the class is graded a little bit on a curve in that you have 5 extra points if you do the extra credit that can be applied towards anything, towards a grade. So if you didn't do well on an individual assignment or the midterm or a group project, you have the ability through the extra credit to kind of make it up, right? So that is upcoming this semester. I've been saying a lot, so let me pause to see if there's any questions about any of this.
Yeah, I have a quick question.
Go ahead.
So the replacement assignment, we can't, let's say we got hundreds on all the homeworks. We can't use that replacement assignment to contribute to getting an A in the class, reaching that 93-point mark.
So the other opportunity for extra credit is, in addition to the 5 extra points from either the 2 points in homework 9 or technically homework 12, you can consider as now the extra credit, or the 3-point extra credit assignment, is down here. You have the ability to write a paper for a replacement assignment, and that is good through the end of day Monday. If you do this, what's going to happen is any of these individual assignments, the 12 homeworks or the Bloomberg certification, the TAs will look at the lowest grade and basically the most points and give you credit as if you did the assignment with full credit, change it to full points. And if you missed it, treat it as if you made it. So let's just say that you, for whatever reason, didn't do homework 8, just forgot about it, skipped it, missed the deadline, dog ate your homework, whatever. So if you do the homework replacement, we'll give you the 3 points and we'll treat it as if you turned it on time. So the homework replacement applies for both of those. It treats it as if it were turned in on time with full credit. It's optional, so you don't have to do the homework replacement, but if you do it, it will be applied to one of the papers. Now, you don't actually decide what to replace. Next week, when the TAs do the grade opt-out criteria for the final exam, which we'll talk about in a second, the TAs will go through and apply the homework replacement criteria and tell you which assignment they've replaced. Okay. But if you don't do the paper, they won't apply that criteria and it won't replace the assignment. You can use the homework replacement for any individual assignment. You could not use it for a group project, and you cannot use it for your midterm exam. Other questions? Somebody said, how many total points are there? 105. 105 total points after the extra credit. Actually, today there's 102. But I'm going to add 3 points for the extra credit on Wednesday, and there'll be 105 total points out there. Okay. Now, the final thing I want to mention that's coming up is Wednesday, for many of you, will be the last day of class, a week from Wednesday, May 5th. You'll do your final presentations, and then you'll be done. The only thing remaining after that is the final exam on May 10th. Now, between Wednesday, May 5th and Friday, May 7th, the TAs will also apply the final exam opt-out criteria, which is listed in the syllabus, but basically a minimum grade on all of the individual assignments. You can't miss any of them. Plus, they'll go back and check all your attendance records on the Zoom logs. Okay. If you meet the opt-out criteria, then on Friday, an announcement will be made. And what will happen is they'll just go to your final exam and they'll give you 10 points, as if you took the final exam and got a perfect score. So basically, you'll see 10 points listed for your final exam. If, when the announcement is made on Friday, May 7th, you see a 0 by your name, it means you didn't get the opt-out points, then you have to take the final exam in class on Monday, May 10th. Okay. So for those of you that opt out, May 5th is basically your last day. For those of you that don't opt out, you will, in class, just like the midterm, take the final exam on Monday, May 10th. That final exam will be a multiple choice exam, which will cover the content that basically goes cumulatively throughout the whole semester. And it will be graded automatically by ELMS as you take the exam on Monday, May 10th. So that is the final exam, and that is the final exam opt-out that is coming up for this semester, right? So again, the criteria for the opt-out will be placed next week. So a lot of moving part logistics as we get here to the end of the semester, and I just wanted to give everybody a heads up on those. So before we talk about homework 11, again, any questions about any of that? All right, let's talk through homework 11. So in homework 11, you had to basically, for the pharmaceutical industry, go through all the data for Merck, Johnson & Johnson, and Eli Lilly. Where are these markings from the earlier class? All right, so these would have been the data points based on the PEs over the weekend. Your PEs might be slightly different depending on which day you did it. I did mine over the weekend, but basically these would be the Gs given the ROEs, which I use the averages of the next several years. And again, the WACs and cost of equities as of this weekend. So let me start here and just say any questions about the data points before we do the analysis. So is it reasonable for a company to have a G in perpetuity that's negative? What do you think?
If the company's in a declining stage, then yes.
Okay. Is Merck in a declining stage?
I'm not too sure about their business specifically.
Okay. So I just want to expand your definition of decline. So what I would say is what a negative G in a perpetuity means, one, it could mean the company's going down to business, but I don't think that's the case for Merck. But basically what the negative G in perpetuity means is that the future is worse than the present, right? It's kind of like an inverted yield curve, right? So basically, if you think about this was I was drawing for the last class. If you think about value over time for a company, most companies follow a company life cycle, which looks like a product life cycle, which looks like an S curve, right? So we have a startup stage, we have a growth stage, maturity, and then a decline, and then the company ends, okay? So here's the point. When we do a perpetuity, we're representing the ending part of the firm. I said, one of the problems is right here when you do the perpetuity and you're trying to value the firm because the firm is in growth mode. Okay? You're trying to do a G that represents all of this future. But the problem is if you use the G that's actually based on the curve it is today, you're going to overshoot the firm because you're not going to capture the fact that it's going to mature and eventually decline. So what you actually need to do is kind of an average of these two periods and come up with a G that looks closer to that sloping line. Okay? That would be the G you would need if this was the period you're valuing. Now, if you're valuing the company and it's right here, then you have the maturity and the decline period. And some companies can actually have a very long maturity period before they go in decline. So therefore, they're fairly stable. That's actually where we want to be in most valuations. The trick is when we get a company that's right here. It's actually doing reasonably well, but the future is a little bit worse. And I think that's the case with Merck, okay? So it's not that Merck is going away. What it actually represents, and this is just an understanding of Merck, is that if you actually go to Merck US Equity, that's why I said you can't really just plug and chug on all of your analysis. It's helpful to know something about the companies that you are evaluating. Merck actually, if you go to EEO, is expected to grow. So you kind of look at this, you're like, how does this make sense for a negative G? They're actually expected to grow and make more profits. Well, if you go over to this third tab, which is pharmaceuticals, this is forecasted sales by drug from their best-selling drug called Keytruda, all the way down to, scroll down, to the launch drugs, which are stuff in clinical trials they haven't launched yet, may never launch. So these are what they could sell. And the point is, what you start to see about Merck is that Merck is really one giant drug, Keytruda, and a bunch of small drugs in terms of their sales, right? And Keytruda is actually one of the best, if not soon to be the best selling drug in the world. And it literally is a drug that cures cancer. It's immunotherapy. And if you have cancer and you take Keytruda, it can be life-saving. As a matter of fact, the original drug that Keytruda is based on was also sold by Bristol Myers under the brand name Opdivo, was used a number of years ago with former President Jimmy Carter. He had terminal brain cancer. The doctors told him he had months to live. He was going to die. They gave him Opdivo. And not only did it cure him, the brain cancer went away. And that's actually one of the miracle stuff of what this immunotherapy can do. And Keytruda is one of those types of drugs. And so for certain types of cancer, it's a miracle. But for a lot, it only works on about 1/3 of people. So for the other 2/3 of people, you're still kind of in trouble. But the point is, if it does work, it can be a life savings. But this drug is also very expensive. It's $100,000 a treatment. So it's extraordinarily expensive. But regardless, it's Merck's biggest selling drug. It's a blockbuster. It's growing ever bigger. The challenge for Merck is this drug, which has become most of the company, it's 1/3 of its sales, is one day going to go off patent. And just like you can see Januvia sales going from 5 billion to 1 billion, or here 4 billion to 1.2 billion, when a drug goes off patent, sales collapse. And or Janumed's another good example. So the point is, at some point, this drug's going to go off patent, and these $24 billion of sales a year are going to go away. And Merck doesn't really have anything in its early stage pipeline to replace it. So if you really want to interpret, which I'm trying to do, why does Merck have such a low PE and a negative growth? It's not that people are worried that Merck is going away. What they're worried about is that the future is going to be more challenging than the present, right? And it's the longer term future into perpetuity that their best-selling drug is going to go off patent. They don't really have something to replace it. So that's, I think, the reason for the negative G. So it's not that they're in decline as much as they've peaked, and people are more worried that the future will be worse than it is today. So that's another way to think about Gs, and Gs can be negative. But you have to understand why a G might be negative when you have a negative G if you're dealing with that data. So again, I'm going to pause. Questions about any of that? See if that makes sense.
So it's generally okay for, like, when we're doing these multiple models, for a growth rate to be negative, as long as like we can see why that's happening.
Correct. And that's actually where I'm going to go after we do this pharmaceutical example, is that, and this is true for everything we're doing this semester, is that I'll go with the 80-20 rule. 80% of the time, you're going to plug and chug with these academic formulas, and it's going to explain the real world. But every now and then, the 20%, the academic formulas are not going to make sense. One of the data examples I'll show you a little bit later is sometimes Bloomberg just gives you really weird data. And you basically put in your academic model and you're like, this just doesn't make any logical sense. There's something wrong here. And so you have to come up with a more reasoned view of the data. Or sometimes, again, for reasons like we're starting to touch on with Merck, the past and the future look far different, and we have to come up with a more reasoned view of what we think the market realistically thinks the future was going to be. And I'll give you that example when we talk about airlines in just a few minutes. Because if you were to value the airlines based on their current situation in perpetuity, the current situation doesn't represent the long term of an airline. All right, if it does, God help us. So the point is that what does the airline industry look like long term? We have to create that, because anything in the next couple of years has nothing to do with what it looks like in a more stabilized business. So it becomes a tricky business to actually value for the two reasons that I just gave you. So I chose the pharmaceutical industry because that's not the case, right? That's not the case in these firms. It's relatively straightforward. I knew the valuations were going to work. For the other industries, sometimes you'll run across a company or an industry where the math doesn't make sense. And that's why, regardless of all of this, I go back to, from a financial standpoint, you got to understand what the data is telling you. There's got to be some contextual story around it, so that, yes, the math solved the equation, but am I putting in the right inputs to the equation? And to some degree, do I even have the right equation? Because every now and then my equation will break down. So we just have to be situationally aware. And that's what will separate better finance people from the less better finance people, because the less better finance people just plug and chug, and they don't know what to do when the model gives them a weird data point. Right? And we just have to be sensitive to that. And we have to also be sensitive to the context to say, is negative 2.57 a weird data point? Can I explain the negative G of Merck once I do that? If I can't, then maybe there's something wrong with my inputs. If I can, then I can live with my input. That's why I took the extra time to explain to you what's going on with Merck, because in that context, you could see whether the market's right or wrong, how the market could come up with a negative G situation for the company Merck. And that's what I wanted to at least mention here. Good question. Other questions? All right. So now we're trying to go through the analysis and we're trying to understand. We'll start with, why is Merck trading at a discount to J&J and the PE? And the analysis is pretty simple. Start with the spread. Merck's spread is much higher. It's 51 minus 7, right? Points of spread versus 34.8 minus 7.7. So essentially 35 minus 8 is a lot lower spread than 51 minus 7. So Merck has a much higher spread. Well, that's not why they have a lower PE. Second, Merck has a lower cost of equity. Their cost of equity 7.1%. J&J's cost of equity 7.7%. So again, it's not the cost of equity that's causing this PE to be lower. So the reason the PE is lower at Merck, the reason it's trading at a discount to J&J is solely because of the growth rate. Because J&J's growth rate is about 2% a year, 1.77. And Merck's growth rate is negative 2.57% per year. And it's that negative G, which is the entire reason why Merck is trading at a discount of 11 versus 16. This one was very straightforward. As a matter of fact, it's the exact same reason why Lilly is trading at a premium to Merck. Because Lilly is growing at 3.11% per year against Merck's negative 2.57 on a compounded basis with an even higher spread of 92 minus 7, 7.6. So this much higher growth, the much higher spread is why they're trading at a premium, even though they have a slightly higher cost of equity, 7.6 versus 7.1. So this should have been fairly straightforward in your write-up, in your analysis, as you thought about these three companies. In fact, even if I'd asked you to do J&J against Lilly, you could do the same thing. J&J, much lower G versus Lilly, 1.77 versus 3.11. So Lilly has the higher growth at a much higher spread for the similar risk. And that's why Lilly's trading at a premium. So very explainable, very understandable how this puzzle fits together. Or this is to me. Questions to you? Any questions about how we just looked at this?
Professor, I have a question.
Yep.
How did you calculate the expected ROE?
For which company?
I had a hard time with Lilly.
Well, what I did is I just took the 3 years, which is all we had. So I'll go over here. Of EEO. And basically, it's an average of the 3. It's been pretty high over time. So the question is that an outlier or is that realistic? So what's basically seems to be going on here, because the ROICs are pretty high too, is that Lilly just doesn't have a lot of equity in its capital structure. It relies on more debt. And the other thing is, when you get to a high level of return on investment, it doesn't matter whether it's ROIC or ROE, when you do key value driver, it doesn't matter whether this number is 90% or 60%. Notice how the PE barely changes. Because what actually happens, this goes back to a slide I showed you earlier this semester, is that when you have high ROI, you're basically not reinvesting as much to generate the same profits. So in perpetuity, it basically means you don't have a lot of reinvestment in your free cash flow. You don't need it. You make a lot of gross cash flow, but you don't have a lot of gross investment because you have a high ROI. And the key value driver, the perpetuity value, is a lot about that reinvestment. It's what is that amount of money you're making that you're reinvesting and how fast is that growing? So you got to think of a business as two pieces. I have the stable, mature part of the business, and I have the growth part of the business, and I'm adding them together. If I don't have a growth part of a business, because I'm not really spending money to grow, because remember, sustainable growth is the investment rate times the ROIC. And so if I have a high ROIC, I have a low investment rate. How the formulas start to fit together. So the point is high returns means I don't spend a lot to grow, which basically means that I don't have a lot of reinvestment. And without a lot of reinvestment, then my current cash flows drive a lot of my value, which means my valuations get very sensitive to growth, not to spread. High spread companies don't change a lot of PEs. High growth companies change a lot of PEs. So the point is, when you get to an extreme spread, it doesn't matter anymore. Because what it means is you're reinvesting so little in the future that none of that growth really matters unless you actually physically grow the business to be bigger, get more customers. So long story short, this number I just took as an average of the three. All right. And whether or not you'd even lowered it, it wouldn't have changed your result too much. You'd still have a G somewhere around 3% to basically get that. For Johnson & Johnson, as I said, I took the average of the three. It was pretty consistent. The same was for Merck. Right. Now we did EV to EBIT. This would have been the data, again, that I got. These were the WACs as of this weekend. These were the tax rates from the JP Morgan analyst reports. And then these were the operating ROICs for 2020. Now, again, this is another assumption because when we went to Merck, screen that I did this on, and then I went to RV, this is an idea that I'm trying to represent in perpetuity what I think these spreads are going to be. And if I looked up my operating ROICs, then what I noticed is my ROEs weren't changing, which suggests that my ROICs aren't going to be changing. Right? Because if I have pretty consistent profits, I should have pretty consistent ROICs. So my current ROIC seems reasonable to be my future ROIC. So I use the 2020 ROICs on a go-forward basis. Right? That's where I got the 16% for Merck, 36% for Lilly, and J&J's 41%. Okay, but that was based on the idea that the ROEs were consistent, and therefore the ROICs are consistent. Now, another way I could have done this is I could have actually done an as-is valuation for each of the companies. And using the as-is valuation, I could have looked to see what happened to the ROICs over time that made the as-is work. And I'm telling you that they probably would realistically be close to these numbers just because of the stability of the firms that we're looking at. Because like I said, today, these are companies are in more mature state rather than high growth mode. So that would get these numbers and that would get these multiples. And then you had to explain them. And this one, again, should have been pretty straightforward. Why is J&J trading at a premium to Merck and EV to EBIT? Well, again, it's going to be the higher growth rate, 1.38 versus negative 3%. At the higher spread, 41 minus 7 is a lot higher than 16 minus 6. Even though J&J is paying a little bit higher tax rate, which is hurting their multiple. And even though J&J has a higher WACC, which is hurting their multiple. But it's the growth at the higher spread is why they're trading at a premium. So it's almost the same analysis as PE because the other factors don't matter as much. With the exception that if their WACC was the same, then their multiple would be an extra 3 points. It'd be 16 multiple versus 13.7 multiple, right? So they are being somewhat offset by that higher risk level of J&J. Why is Lilly trading at a premium to Merck, double the PE, double the EV to EBIT? Same reason, which is much higher spread. 36 minus 7 is much higher than 16 minus 6. Tax rate is a little bit lower at Lilly. That helps the actual EV to EBIT. And more importantly, they're growing at 3.3% a year versus shrinking 3% a year. And that growth at the higher spread, even though they have a higher cost of capital, is why they're trading at a multiple that's double Merck's. So again, there's a couple more variables that you have to mention, but no different in your analysis for EV to EBIT than what you did for PE. Again, pause, questions. All right. So the final one is you had to do EV to sales. And Merck is trading at 4 times next year's sales. J&J is trading at 4.6 times next year's sales. And we said one of the key drivers was profitability, and Merck makes more money when they sell things. They make 38 cents a profit. J&J makes 34. And after tax, 32 and 28. So what explains this? Why is Merck, despite the higher profit, trading at a discount of EV to sales? What did you guys say? What would explain that? Because you would expect if you make more profit when you sell something, then the sales will be more valuable. Why are they less valuable at Merck? Despite the higher profit
Is it
percent.
because the productivity is so high? Like it costs more invested capital for them to make the sale?
Exactly. And if there's cost more to and productivity is higher, that means they have more reinvestment, more gross investment. So they're taking that profit, they got to reinvest more of that profit to sell the same product. They're reinvesting at a rate 3 times as much at Merck as they are at J&J. And that means that sale is not worth as much because they got to reinvest more. Another way of saying that is that's why they have a lower ROIC, because they're reinvesting more of the profit. Their return on investment, because there's more investment, is lower, and therefore the sale is not worth as much, which is why they're trading at a discount. Despite the fact that Merck has less risk, 6.3 versus 7.2. And Lilly, similar story. Again, Lilly relative to Merck, lower margin, 34 versus 38. But Lilly also has a lower tax rate than Merck. And Lilly, like J&J, invests less. So the additional point with Lilly versus J&J, why it's trading at a little bit higher of a premium, is in addition to the lower investment rate, Lilly has a lower tax rate, and Lilly's risk is a little bit lower than J&J. Plus, Lilly's growth rate indirectly is affecting this. So when you put all that together, Lilly is trading at the highest premium for EV to sales. But all you really had to say in your paper was just the basics, was that Lilly and J&J both had less margins, but both benefited by being more efficient. And at a similar level of risk, that's why they're trading at less EV to sales, or more EV to sales, should I say. Again, questions about how any of these work?
Professor, did our EV have to match up exactly to the model EV have to match up exactly to the actual EV, or if it was a couple decimals off, is that okay?
Well, it could be a couple decimals off because it depends on what your PE was at the time. So, I mean, if my PE was 20 point, or my EV to EBIT was 20 point, I don't know, what was that number, 20.65, because I did the stock price on a different day, then I'm going to get a different G. Okay. And by the way, here's a quick shortcut for G. If you, instead of kind of going back and forth, you can actually use GoalSeek within Excel to help you solve for a G. So what you can do is you can set a cell that you're trying to solve for. In this case, my model EV to EBIT to whatever value you want. So at this point, I wanted to go to 20.65. And I'm going to change cell D5 to do it. And what Excel will do is it'll basically solve for it. So now I would get a G of 3.34 to get these to match. And that would be a perfectly acceptable answer, because obviously you did it at a different time than I did, because the stock price is bouncing around every day. Okay. But again, you're still going to get a number close to this. You shouldn't get a number of like 2 or 4 for Lilly. It should be somewhere in the low 3.3 range, plus or minus, because the stock prices didn't change that much last week. So plus or minus, 10 basis points is what you should have for your Gs. Other questions?
Professor, do you think Merck's reinvestment rate is so high because of those patents that are coming to a close soon?
Well, I think the reinvestment rate is actually so high short term is actually the opposite. Merck is a little bit of a challenge because what Merck is actually trying to do is scale up to sell more Keytruda. So in the short term, their sales are growing pretty rapidly from 47 billion to 59 billion. But all that growth is Keytruda. And it's actually fairly expensive to manufacture. It's probably costs $100,000 a drug because the immunotherapy, it's not a pill. It's actually an infusion that you have to take. So they have to build facilities around the world to make Keytruda. And these are expensive facilities. It's no different than the vaccine makers that are putting billions of dollars to quickly ramp up the vaccine. They're doing it on a longer time scale, but they're ramping up their facilities to sell from 17 to 24 billion. So they're spending a huge amount of I, which right now is lowering their ROI. Okay. Now, it is going to help their ROI get better in the next couple of years, most likely, once they stop building their facilities. But as I said, eventually the sales and profit are going to go down because they're going to have these facilities, but then the drug is going to go off patent in 7 or 8 years, unless they can figure out a way to extend the patent or find something else. So I think the market is worried that Keytruda is going to go on a great run, but they don't have something in perpetuity to replace it, right? But in the short term, the ROI is also being somewhat depressed because they're spending heavily to go get those sales before it runs out of patent. A little bit of a paradox there. But regardless, that's, I think, the way the market is starting to price Merck, right or wrong. That's what the data is showing. Other questions? All right, so last couple things I want to mention. So I'll post the solution today, so you'll be able to see what the math was, but you hopefully got numbers pretty close to this. So a couple last things. Let's say that your next assignment is on the airline industry, and you had to do United as an example. I mentioned this in class before. You come over here, you're trying to figure out return on equity. What return on equity would you put into here, given this data? What's the perpetuity return on equity for United? What would you use? And I'll give you a hint, could be none of the above.
I think you might have to go back and look at 2019 and see what their levels are there.
So let's look at FA. I'll go to custom, create a custom, and I'm just going to type in ROE. So there is 6 years. In fact, I'll switch this to 10 years of historical ROE. And the point is, it's really the last 6 that are probably more indicative of the airline industry before the virus. But these 4 years, United was pretty stable, right? So if I'm trying to understand how United is doing, like this period of time is probably more representative of where they're going to end up than where they are today. Okay, because today is not the future, and even next year might not be the future. So unfortunately, I don't like doing it this way, but I have to kind of create what I actually think a reasonable future might be. And so that way, this might be a guide. Same thing for ROIC. Like if I look at return on invested capital historically, I might use that to say, look, they were generally in the high single digits to low double digits during this period of time. That's probably post-pandemic in a few years, the level an airline might achieve. So the airline industry would have been a much more difficult assignment because today doesn't equal tomorrow. And it's not representative. The last few years are not representative of the perpetuity period. So I would have to create the perpetuity period. And I had to put an additional set of assumptions in order to basically make my model make sense. That's a far more difficult industry to do an analysis on, but I'd still have to come up with a way of explaining the multiples. And I couldn't explain the multiples based on the data that I saw. Okay. So I'll just say that your analysis is kind of like an 80-20 rule. Most of the time, just like the pharmaceuticals, it's a pretty straightforward analysis, but every now and then it's not going to be a straightforward analysis. And you're going to have to come up with data that makes more sense and explain what you see. And sometimes when you plug and chug, what you see won't make sense. And I'll give you one last example. Last semester, homework 12 in the fall section was doing it on these three companies, Procter & Gamble, Clorox, and Colgate. And this was the data in Bloomberg for PE, the time that they were doing the assignment. And the problem was Clorox and their cost of equity. Their cost of equity and their WACC was much lower than Procter & Gamble and Colgate's. And when you actually looked at the data, it didn't make sense because they weren't fundamentally less risky. And even the analysts weren't using a much lower cost of capital in the analyst reports. The analysts were actually using cost of capital, which were similar to their peers. And so when you actually did the math with the low cost of capital, you got a very low G. And the low G did not sync up with the fact that Clorox, particularly at the time of the virus, was actually expected to grow, and with growing globally with all of their products, the long-term G didn't really make logical sense. So what we ended up having to do is say, look, every now and then, this is a quirk data in Bloomberg. We didn't think that Bloomberg, and I don't think most analysts did either, said that this really represented their long-term risk. So if we reset their risk in the Clorox alternative to what we thought was a more appropriate cost of capital, similar to their peers, which is actually what Wall Street was using, then that became their G, which was much more in line with the data that we saw and much more in line with the peers, which was also in line with the fact that they were all trading at very similar multiples and much more explainable, because this is much more explainable to the same multiples than this, because you got to make some gyrations to make your story make sense. So that's the other nuance that you might run into when you have to do a multiple analysis. Sometimes you'll get the answer, you'll look at it, and you're like, I can't tell a story to explain what I'm seeing. And so you have to kind of go back and start to ask myself, am I putting in the right assumptions? Now, these are exceptions. Most of the time, you won't have this problem, but I did want to alert you to this because your next assignment might involve doing something like this. And at the same time, you're also, when you deal with the real world, it's not as clean as the academic formulas always fit out. So I wanted to at least highlight that. Questions about any of that? Okay, so basically, this is where we're going to stop. So Wednesday, just remember, there's no Zoom lecture, right? We're pretty much done with the content for the semester. So all you're going to do on Wednesday is I'm going to give you class time to work on the extra credit, right? Now, technically, the extra credit is going to be due on Monday. So really, on Wednesday, you can do three things. One, homework 12 is due next Monday. It's worth 2 points. The extra credit's worth 3 points, due next Monday. You're optional to do that. And your general dynamics presentation is due a week from Wednesday, and you might want to start syncing up with your teams. So I'm giving you some class time and some Bloomberg lab time to work on those assignments as we get close to the end of the semester, but those are the things that are upcoming. If nobody else has any questions or comments about that, I'll see everybody in our next Zoom lecture next Monday. Remember, TAs have office hours this Thursday or Friday. Optional peer review available this week if you need to do it. And again, if you want to do that homework replacement assignment, that paper to basically replace an individual homework assignment, make sure you do that by next Monday. A lot of moving parts here as we get to the end of the semester. Have a good week, stay safe, and I'll see everybody a week from today.